Hello everyone, welcome back to Fundrise Finance. Even with the stock market moving back and forth from the bear market territory, one thing we have seen so far this year is good dividend paying companies have not only continued paying their dividends but also kept increasing them. But even if markets slowed down year to date, not every company is undervalued, and we should make note of it before investing into such companies. In today's companies, we will go over 5 companies which have announced dividend raises in the recent weeks and see if they are overvalued or undervalued. Let's check them out. First on our list is the James Smucker Company, ticker symbol SJM. We know the James Smucker Company from its famous Smucker's jams, as well as the Jif peanut butter, and also Dunkin' and Folio's coffees, and also a few well-known pet food brands. Year-to-date, SJM has been in the negative, returning minus 3.66%. The last 1 year also, it is slightly negative, down just below 0%. The last 5 years, it has returned 13 plus percent. So overall, this consumer staples company has not gone anywhere actually. So many would treat it a dud, but income seekers do get a nice 3% dividend yield from this stock currently. It has a market cap of $14.04 billion with a forward PE of 16.32. From dividends perspective, SJM has been raising its dividends for the last 19 years at a 5-year growth rate of 5.71 and a payout ratio of 44.54%. SJM had recently announced a dividend raise of 3%, which is well below its 5-year growth rate. Tracker Dividends gives SJM a dividend score of 65 and considers it overvalued by 13.61% with a fair value estimate of $113.85. Morningstar considers SJM a 3-star stock with a fair value of $144. But as for my dividend theory calculations, which considers current and historical dividend yields, I found SJM to be undervalued by 4.38% with a fair value of $137.56. I don't own this stock personally in my portfolio and don't plan to invest into it because I don't see the investment going anywhere. The second stock in our list is National Retail Properties Inc., ticker symbol NNN. This is from the real estate sector and considered a REIT, which is a real estate investment trust, and generally invests into high quality retail properties. Year to date, National Retail Properties has returned a negative 7.51%. In the last 1 year, just below 9%. The last 5 years, it's just almost 12% returns. It has a market cap of $7.8 billion and currently yields 4.78%. From a dividends perspective, National Retail has been raising its dividends for the last 12 years at a 5-year growth rate of 3.1%. Recently, National Retail Properties had raised its dividend by 3.8%, which I would say is in line with its 5-year growth rate. Tracker Dividends gives National Retail Properties a dividend score of 51 and considers it overvalued by 12.09% with a fair value estimate of $38.98. Morningstar considers National Retail Properties a 3-star stock with a fair value of $46.85. As for my calculations, I found National Retail to be undervalued by 4.73% with a fair value of $46.44. I do own a very little portion of this company in my portfolio, but I don't intend to add any to my current position. Perhaps if the stock falls a little more, then yes, I may look to invest into it. The third stock on our list is Enterprise Products Partners, ticker symbol EPD. Enterprise Products is from the energy sector and year to date has returned 8.3%. The last 1 year, almost 2.5% returns. It has a market cap of $53.46 billion and currently yields a very high 7.46% at a forward PE of 9.85. EPDA has been raising its dividends the last 23 years at a 5-year growth rate of 2.34% and a payout ratio of 84.6%. Recently, EPD had raised its dividend by 2.2%, which is in line with its 5-year growth rate. So yes, the 5-year growth rate does look small, but currently as it yields 7.8%. So this particular stock is mostly geared towards income investors. And one should notice that as Enterprise Products is a limited partnership company, which means that if you own a stock of this company, you would be considered as a part owner, and so it will be taxed differently. You would get a K1 form as part of your tax documentation, unlike a 1099 dividend form. So that requires a whole lot of different process to have your taxes filed. So please make sure you know all those facts before investing into this company. Tracker Dividends gives EPD a dividend score of 42 and considers it undervalued by 13.69% with a fair value estimate of $28.41. Morningstar considers EPD a 4-star stock with a fair value of $27.50. As per my calculations, I found EPD to be undervalued by 6.91% with a fair value of $26.21. The fourth stock on our list is Cummins Inc., ticker symbol CMI. Cummins is from the industrial sector that designs, manufactures, and distributes industrial components worldwide. Year to date, Cummins has fallen almost 10.5%. In the last 1 year, it has fallen just over 18%. Last 5 years, Cummins has returned just over 19%. It has a market cap of $27.71 billion and currently yields 2.95% with a forward PE of 11.19. From a dividends perspective, Cummins has been raising its dividends for the last 12 years at a 5-year growth rate of 7.18% and a very good payout ratio of just below 40%. Cummins had recently announced a dividend raise of 8.3%, which is above its 5-year dividend growth rate. Trackio Dividends gives Cummins a good score of 86 and considers it undervalued by 23.87% with a fair value estimate of $260.46. Morningstar considers Cummins a 4-star stock with a fair value of $238. As for my calculations, I found Cummins to be undervalued by 17.92% with a fair value of $231.55. I do own Cummins in my M1 Finance portfolio and have been adding to it in the recent downturn and will continue to do so as long as it remains undervalued. The fifth and final stock on our list is Morgan Stanley, ticker symbol MS. Morgan Stanley is from the financial sector and provides various financial products and services that includes wealth management and investment banking. Year to date, Morgan Stanley has taken a real beating, falling more than 22%. In the last 1 year, it has fallen almost 16%, but in the last 5 years, we can see an impressive growth of 73%. It has a market cap of $134.48 billion and currently yields 3.59% with a forward PE of 11.74. Seeking Alpha shows Morgan Stanley raising its dividends just for the last 1 year. That's because between Q3 of 2019 and almost Q2 of 2021, we see the dividend stagnated at 35 cents. But after that, we see a monster dividend raise of 100% that was announced in the Q3 of last year, which also boosted its 5-year dividend growth rate to 28.5%. The payout ratio is 37.29%. Morgan Stanley had recently announced a dividend raise of 11%. And for those interested to invest into Morgan Stanley, it has its upcoming ex-dividend date of July 28. So if you do own a stock of this company before that, I'll be paid a 78 cents per share on August 15th. Tracker Dividends gives Morgan Stanley a dividend score of 75 and considers it undervalued by 14.18% with a fair value estimate of $90.95. Morningstar considers Morgan Stanley a 4-star stock with a fair value of $95. As for my calculations, I found Morgan Stanley to be undervalued by 25.6% with a fair value of $98.03. I do own Morgan Stanley in my M1 Finance portfolio and will continue to add to it given the stock is so undervalued. So these are the 5 stocks which we just discussed. To summarize, James Mucker, National Retail Properties, Enterprise Product Partners, Cummins, and Morgan Stanley. So as we can see here, Cummins and Morgan Stanley are highly undervalued and give a good buying opportunity at the current levels, which I feel one should make use of. That's all I have in this video. Hope you liked it and found it valuable. I would really appreciate if you could hit on that like and subscribe buttons, which would help YouTube recommend this video to many people out there. Until we meet in the next video, let's try to do as much as possible to be financially healthy. See ya. Bye.